Welcome to the Valuability Podcast, episode 29, The Critical Value of Life Insurance, Part 2. The Valuability Podcast is for financial professionals, business owners, and anyone interested in financial planning, business, leadership, and personal development. We believe that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. My name is Danforth Fleek. I am your host and was a financial advisor and product wholesaler for over 20 years. As I was thinking about this follow-up part 2 with our discussion on the critical value of life insurance, I was thinking about the historical split between life insurance and securities that happened in the United States. 1929 stock market crash and the ensuing depression. After that, banking, life insurance, and securities were split for many decades. And as I was coming into the industry in the 1990s, that was beginning to fade away. And so people in the securities business were able to start talking about life insurance products. But there has really remained, I don't want to say a level of distrust. There certainly was a level of distrust when they were all split in the 50s, 60s, 70s. The different sides of the financial services industry competed and sometimes weren't nice about it. That's probably the best way to put it. But as that has started to fade away and we have started to look at a more holistic approach to financial services, that residual has stayed. And if you have come to the business either from the life insurance side or the security side, I just want to say definitely make strides to build into your practice an entire well-rounded approach. I come at it because I came up through the security side. I look at it primarily as securities individuals that don't spend enough time on the life insurance side. That's my frame of reference for it, but certainly there are folks that come at it from the other side as well. But regardless, the holistic approach is the right approach. But even if you don't talk about the other side, find a partner, find people that you trust that you can refer your clients to, and at least have that conversation of, hey, I only do this. I talk to people about this all the time. If you just want to be an investment advisor, that's fine. Just be an investment advisor. Refer then your clients to someone who can help them with the things that you don't want to focus on. There is no reason why you have to do it holistically. I would prefer it if I were a client, and I would prefer it as a professional, but you don't have to. It's a free country. But if you are focusing on one, make sure that you have in place an advisor, someone, as an example, like Rod Crandall, or someone else in the industry that you can refer for those other cases. So I will get off my soapbox on that topic. You can find the Valuability Podcast wherever you find your podcasts: Apple Podcasts, Spotify, Stitcher, TuneIn. We should be there wherever you get your podcasts. We also have a YouTube channel. Search Value-Ability on YouTube to find us there. Or you can find us, of course, on our website, value-ability.com. Click on the episodes tab and our episode player is there. Wherever you find us, please like, review, subscribe, and share. If you'd like to connect with us, you can email us at info@value-ability.com. Again, that's info@value-ability.com. If you'd like to connect with us on social media, we have Twitter, Instagram, Facebook accounts. Go to value-ability.com, click on the Contact Us tab, and all of our social media links are there. If you didn't get a chance to listen to part 1 of our conversation, definitely go back and check that out on the Valuability player. And now we will return for the conclusion of our conversation with Rod Crandall. And now we are back for the second week of our discussion with Rod Crandall about all the many uses of life insurance and how those discussions go between financial professionals and their clients. Philip, you wanted to start out this week with with our special question.
Yes, thank you, Dan. You know, oftentimes, for our consistent listeners, when we have a guest, we ask them, what pearls of wisdom did you receive from someone who, important in your life, a mentor, could have been a grandfather, father. I think one of mine, Rod, that my father bestowed upon me, and I'll never forget, says, look, never get in a pissing match with a skunk, because even if you win, you're going to come out smelling second best. So, right? So I've taken that also, 37 years of marriage. I've asked myself now, and how do you sum up 37 years of marriage? Well, some of it tragic, most of it magic. I wouldn't have it any other way. And I ask myself this question: would you rather be right, or would you rather be married? And that's helped me not get in that pissing match with the skunk. So, do you have any, Rod?
I love those, Philip. I mean, I think the one that resonates most with me is that, people don't care how much you know until they know how much you care. And that's really important in my life. And it's important in success in insurance integration, in my opinion, because we have to get to that level and be able to really have the client understand and believe that we know what their goals are and we're willing to educate them. We're going to put it in context for them, make it as easy as possible. And a lot of times you have to earn that right. Otherwise we're asking them to buy something that they don't want to buy and pay a price that they don't want to pay. And so that does lead a lot of what I do. So people don't care how much you know until they know how much you care.
And to a large extent as well, and we're seeing this in a lot of parts of our society and the risks that exist out there today. For me personally, when I was a young financial professional, and I think I told you this story when we were chatting about coming on the podcast, Rod. I was an internal wholesaler working in the investment realm, and I ended up doing a portfolio for this with this advisor on the phone, and he ended up actually handing the phone to the client, which he shouldn't have done. I wasn't allowed under the company rules to talk to him, but he just handed it because he was having trouble talking to me and I didn't understand what was going on. I didn't have any context. Well, it turns out that the client was the financial advisor's brother, and he had been diagnosed with terminal brain cancer, and the portfolio that we were putting together was the life insurance money that was going to arrive at his death. And so he wanted to apportion it to his kids' college funding. So at the end of this conversation, his wife's there. She's crying. The brother, the financial advisor's crying. I'm crying on the phone. The only guy who's not crying is the client who's dying. And he literally says, what's going on with all you? Like, stop crying. We need to figure this out. But like at the end of that call, it was the first time in my life, I'd heard that, when you deliver a death benefit check, there's nothing more powerful. And you hear these things as a young financial professional, but to be talking to a man who at the end of the conversation says, thank you, I can now go die knowing that my kids are taken care of. And my portfolio had nothing to do with that. It was the insurance that allowed that to happen. Was just like, until people see that and feel that, many times it is hard to communicate that. So you've hit the spot on. Until you get to that heart, to that connection, it's numbers. And you also mentioned last week, like, we're all really good with numbers in this business. It's what attracts us to it, right? Like calculating the return and all that's fun and satisfying. But honestly, to this day, and I think you listeners can tell and you guys can tell, that conversation has affected me in tremendous ways over my life. To have that conversation, I think it's a huge deal to talk about. This is, again, going back to connecting to those values, connecting to those goals, connecting to those emotions. And I'm pretty comfortable with that, but you're right. If you're not, you need to discuss the idea of bringing someone into your practice that can have those conversations with you.
Yeah. I appreciate you sharing that. I mean, it gives me goosebumps. I find that story sad and beautiful at the same time. And
Yep.
last week we talked about the idea that it isn't what insurance is, it's what insurance does. So
Right.
this gentleman is going to die and he's got insurance, and what it is it's a death benefit that's going to show up what 3 days after he's gone. But what it does, I don't even know what it does for his family. I got more goosebumps even thinking about it.
Right.
This is his legacy. It probably is paying off mortgages and providing income and making sure kids can go to college. It's a demonstration that his brother, the wealth advisor, cared enough to have this conversation and put this in force for him, right? And I am so goosebumped right now. I can't even believe it. But it's just a funding mechanism. Now, by the way, that funding mechanism, without being rude, showed up exactly at the time it was needed. Exactly at the time.
Right.
We manage portfolios, and that's good, and that's important, and that's crucial. But with life insurance, we know the exact amount we're going to get, and we know exactly when we're going to get it. And there is some value to that. And the value is in what it does, which I presume is continuing their goals.
His kids, at the time, this was the early 2000s, but 50 grand each for the kids to go to school. The mortgage paid off, wife not working for 2 years. That's what I remember. And like just that in itself, and there was some left over.
Wow.
Like just that in and of itself was like amazing. I mean, amazing to think about the last 3 months of his life, just knowing that that's not an issue.
Right.
And can go deal with all of the other things that he was going to have to deal with.
That's a good point. And I talk to people about this, which is why I keep coming back to we have to have emotionally intelligent conversations. And what I describe to people is if a death or disability or long-term care event happens in your family, I can promise you it's going to be the worst of times emotionally. You have an emotional catastrophe. And I can't really help you very much with that. I mean, I can be a shoulder to lean on, and I'm a caring person. But what I want to make sure is that you don't have a mathematical catastrophe at the exact same time you have an emotional catastrophe, because that's like standing out in your front yard on a sunny day with a magnifying glass, harnessing the power of the sun so that you can light your grass on fire. And when you start thinking about this, and by the way, as an aside, these conversations generally need to be had with both spouses. I do everything I can to avoid having this conversation only with the quote stereotypical man who is probably numbers oriented. Philip, you taught me many times you have to touch the heart before you touch the mind.
That's right.
Which is a derivative of people don't care how much you know until they know how much you care.
Yes.
So it's really the same thing. But we're in the leadership business, and our clients need answers. And if we're not going to lead them to the answers, who is? And my belief is that answer is no one. If we don't do it, no one will.
And that leadership comes down to one word, and that's influence. And you can't influence people till, as you said, you touch their heart, or they know you. It's more important that you have this relationship with them. And I've said this before too in our podcast. As a financial advisor, you're glorified social workers by heart, but you're a capitalist by brain. Because it's amazing, within 1 hour, it's a very unique skill set. Within an hour, the first hour of meeting this person, you are finding out what are the things that's most important to them, and then having an open, honest, frank, confidential conversation of where all their money is. That's a unique skill set, and I love that you brought up Rod. And I used to do this, in it's a tough conversation, but you need to have it with both around risk management here, and you got to have it with both of the spouses there or partners there. And when I would talk to him about the insurance, and I would just have some fun with it, I said, "Now look, Dan, I'm gonna, you know what? At the present time, I'm gonna shoot you. You're dead. You can't say anything now. Don't worry, you're gonna get your chance, but you're dead and gone right now. uh, your survivor, your spouse over here, let's just say Grace is going to be living. I want to know what Grace wants, because this is a conversation that many of our people they never have. So this is the time to address it, and then it's just going into those standard questions. What standard of living do you want to have? Uh, when this occurs, what indebtedness items do you want to be paid off? The mortgage, the car, everything else. Do you want to make sure, is there contingent liabilities or other cash commitments do you have, or what educational costs do you want to incorporate Social Security with your given risk tolerance? How much do you think you could 4%, 5% earn on this money to help? We got a whole set of questions, but you got to have those conversations with those questions. And today, what we're going to talk about is how to, if you can't have those conversations, how could you best coach up, find a good coach to assist you with these conversations?
Grace wants to know how she got married to this bum. This is the first thing she wants to know.
Dan, don't worry. I'm going to shoot Grace here in about 4 or 5 minutes here.
Dan wants to know where Grace is, first of all, so he can find her. I think it's a good point at this point to ask, Rod, how do you see this advisor and partner relationship going? Because many financial advisors are, and with good reason, skeptical of bringing in an outside partner. I've seen multiple times in my career, as someone that used to do this with different products, but also insurance style products, bad partners come in and embarrass advisors. Mm-hmm. And so how do you see that partnership, and how do you set that up with advisors?
Yeah, good question. So, I mean, first of all, reputation risk is real and it's legitimate, and you don't want to mess around. My opinion is the very hardest part of our business by far, maybe a factor of 10, is getting a client who knows you, likes you, and trusts you and will take your advice. And if you have a client who knows, likes, and trusts you and takes your advice, the last thing in the world you want to do is damage that relationship. So that's a real thing. Okay. And I'm being brought in all the time, which means that my advisors are potentially putting those relationships at risk. Okay. So, and I know that acutely. I know it so much that my job is really not to place insurance. My job is to enhance the relationship that exists between the client and the advisor. Because in my world, I'd happily forego an insurance commission so that I can talk about the next 20 clients behind that. And I think about word of mouth all the time. And I know that negative word of mouth travels about 10 times faster than positive word of mouth. So you start blowing up relationships, you're in big trouble. Okay. Now, how do I go about minimizing that? Well, part of it's my values. And I've learned a lot from Philip, and I'm not sure we mentioned it, but he's coached me a number of times and for a number of years. And my value set is really that about being collaborative and being impactful and developing deep relationships. That is so important to me that I can't help but do that. In fact, sometimes one could argue that my production could be higher if I wasn't so focused on strong relationships. Now, with that, what does that really, really mean? What it really, really means is skepticism shows up. And you know what? I was referred recently to an advisor that does between $1 million and $2 million in gross dealer concession. And in the spirit of confidentiality, I want to just describe a little bit about how this guy presented and what he said, and then what we've agreed to. So what he said to me is, Rod, I don't mean to be rude, but 95% of my business is fee-based. And the commissions that I drive are generally from old 12B1 fees or old annuities. And why would I even focus at all on this 5%, especially when I've lost relationships in the past by trying to implement insurance? And Rod, how are you going to be any different than the other brokers that we already have relationships with? So that's skepticism.
Those are good questions.
They're great questions. I mean, here's what I told him. I said, first of all, you may not want to work with me. And I understand how important relationships are. And understand that you've developed a great relationship, a great business where 95% of your business is recurring. What I would ask you is, do you believe that you've set your clients up for the what ifs, right? And let's just take retirement portfolio protection via long-term care insurance. Have you considered that by default, maybe part of your AUM is actually the long-term care funds for your clients? Yeah, that's a good point. What happens if your clients need to draw that down in a down market? Okay. Then I start talking to him and indicating that the success that I've had has to be done intentionally on purpose. And that speaks to how I actually partner. What I sell, I believe, is the intentional integration of insurance in a wealth advisor's practice. If we break that down, you have to do it on purpose. And in order to do it on purpose, you have to do something different than you did before. I asked this gentleman what he's placed. He said he's probably placed 4 cases in the last 4 years. Well, with all due respect, he will never move into insurance planning by himself. And he's been in business for 40 years. So I said, listen, I can tell you anything that I want, but at the end of the day, you're going to be able to answer that question for yourself. Why would I do this? If you'll allow me and commit to me to working on 3 clients together. Because within 3 clients together, we're going to know each other a lot better. We're going to understand how we work. We're going to see whether this could be successful. And then you're going to be able to determine whether I am high risk to you and your practice, whether you should even focus on that at all. And you'll be able to effectively answer that. And by the way, an hour later, when he scheduled 20 minutes, he said to me, now I remember why we hired you. And I think I turned him around, and he did agree to work on 3 cases. And to me, that's what I need, because I need to be able to demonstrate that. If anyone just looks at me like the insurance guy and says, how are you any different? Well, I'm not. If you're going to ask me that, it's just like showing insurance quotes. They're asking me to quote them. And I'm saying, well, if I just quote you, you're just going to throw out the quotes. So we've got to engage. And then hopefully what happens, and I do have recent relevant experience, another Philip saying, that indicates that, you know what? I do help enhance relationships. I do educate and help clients and advisors consider these structures and do it in a spot where we can custom design those solutions inside of the financial plan. I know I was long-winded on that.
Yeah, that's good. That was very good, Rod. And so you identified 3 clients that you could work with. How did you go about identifying those 3? If I've got 200 clients,
Mhm.
and I'm mirroring this potential candidate you are working with, and we are working with this advisor.
Mhm.
It's more advisory, traditional money management. It isn't dealing with the insurance aspect. How would you spot those opportunities?
I would say there's two ways to do it. The first way to do it is to pull out your calendar and say, who are you meeting in the next 2 and 3 weeks? Okay. Now, by the way, one point of clarification, I want to talk about 3 clients before I talk to 3 clients. So I'm not asking to be introduced to the client. I'm asking for you to bring a client forward so we can discuss their situation, what you know about them, what you do for them, what planning you've done, what you know about their legacy plans, any estate planning that they've done, what you know about any of their existing structures, et cetera, et cetera, et cetera. But to answer your question, you can either go into the calendar and say, who are you meeting with? And let's talk about the Jones and the Smiths. Or we can go in and I use a profile form. So we have a nice profile form that talks about the strategies, not the products that a client might present. I generally tell people that sometimes I'm wholesaling ideas, insurance planning solutions. So one might be those that are growing a family, like we talked about last time, the 30-year-old who's earning a good buck and growing a family, who's maxing out their qualified plan, and we need to talk to them about protecting their money machine and maybe creating a supplemental retirement bucket. So that'd be kind of profile one. Profile two might be those that are in retirement or approaching retirement and have more assets than they need, and they intend to transfer these to future generations, especially large qualified balances, which are great for accumulation, but terrible for distribution, especially for the heirs, especially with the Secure Act requiring us to take those dollars over 10 years or less at our highest marginal tax bracket. So give them a profile and say, who do you know that fits into these profiles? And then we're into a conversation, which if you recall last week, what I really want is I want to be able to consider people that we need to have conversations with so that we can educate them on their options and what that means to their goals and their plan.
We've stayed pretty high level here, but I just want to highlight that specific point that you made there, that the Secure Act has now made the discussion of wealth transfer much more vital than it once was, with the elimination of stretch IRAs and being able to stretch qualified plans. There's a famous industry head that calls it the tax time bomb, and it has become a much bigger tax atom bomb for many people now with that specific change. So I just wanted to highlight that. We don't get too much into the weeds of those details, but that's huge. Many investment advisors who focus more on the investment side look at that risk and are traditionally planning around that through the use of stretching. And that's the problem with using those types of strategies, is that, oops, they changed the law on you.
Well, you have trade-offs. And what I talk about a lot is that the very assets that are best for accumulation, like a 401k, that I can put money in on a pre-tax basis and have it grow tax deferred for 40 years, that's a beautiful thing for accumulation, become the worst for distribution. Couple of quick data points. You got that Secure Act, number one. Number two, where are income taxes going over the next 10 and 20 years? I don't know. They probably not down. What about estate taxes? Okay. And so what we find is that, ironically, the most insurance is actually purchased in my practice by clients that don't strictly need it but want it and utilize it as a non-correlated asset class. And oftentimes they can trade off high cost of taxes for cost of insurance, which is often lower than the taxes. But we can't ever get to that kind of conversation if we're just quoting premiums. Go, why would I put $40,000 a year in insurance I don't need? That's crazy. Well, yeah, under that context, it is. But what if that asset for a 70-year-old was guaranteed non-correlated and income tax free to the heirs, and our 20-year return on that was 4.5%? Would that change things? And what I find is that when we can get to that level, it does change things. And you know what? 7-year-olds do write $40,000 checks to fund life insurance they want because it shows up tax-free for the future generations.
That's good. That's a good thing. And that's a great strategy. I'm glad you brought that up. Because that's the insurance has, it's just not protecting one's life. There's many advantages from a tax strategy standpoint that you bring up there, Rod, in working with other advisors and their clients. I was also thinking, Rod, now, if when's it what bit of advice would you give candidates here? And candidates meaning, advisors who are listening to hire out a coach, and what should they look for from that coach? What characteristics or traits? And then I'm sure there's different compensation models that could be used here. Could you just share with us some of your thoughts there?
The first thought is, remember my cell phone number, 847-309-0600.
Dial now, that is 847.
Now, I'm only halfway kidding, but I certainly am biased. Okay. But my first and foremost, you want an insurance person, in my opinion, who's committed to a planning process. If they're not committed to a planning process, then they're going to be focused on product. And if you're focused on product, as I've already mentioned, my belief is that product is too expensive. And then we have to be aggressive to get you to implement the product. 20 years ago, I started with a large mutual insurance company. My closing rate was around 20%. And that's the industry standard in that kind of place. When I get the opportunity to be brought in by a wealth advisor that has a strong financial plan that is leading the way, our implementation rate goes to 80%, 4 times better. And what that means is we have better outcomes for our clients, and it means we don't have to push clients ever. Okay, I don't like being pushed, and clients don't like being pushed. And if we're not committed to the planning, I think it's almost a requirement that we have to push. So that would be number one. Number two, I think you need a partner that, again, is committed to enhancing your relationship, because that reputation risk is just too large. You can't lose clients. And so I think that that's really important. Now, as far as compensation goes, there's kind of a couple different ways that you can do that overall. I mean, you can hire a coach outrightly, right, on an hourly or contract basis or monthly basis. And certainly I can and have done that. You can also split revenue on the cases themselves. And that can be split, between 20 and 50%, depending upon who does what. Certainly, if you have robust staff and your staff can handle a lot of the paperwork that's required, then that split could be shorter. You talk about the learning hospital. So I think that's most people that work with me do it on a commission split basis, which really means that they get me as part of their team with no overhead.
Right.
What they do have to take is they have to take the reputation risk. That's their cost. But now they have no overhead. And I tell people, if you think that I'm taking money off of your table, then we definitely shouldn't work together, because the last thing I would ever want to do is take money off your table. But what I believe I do, and I have been able to demonstrate that, is put money on the table. Like that advisor. I told that advisor who said, why would I focus on that? One of the things I told him is that I can all but guarantee, and that's a weird word in our business, as you guys all know, but I can all but guarantee that we can find $100,000 or $200,000 of revenue in the first 18 months by intentionally looking at this. Right now, that's $1 million plus practice. So what is that as a percentage, and how big is my reputation risk? And I had a different advisor, by the way, said, Rod, when I think about the revenue that I'm losing from insurance, that's not what concerns me. You know what concerns me? Is the revenue I'm losing by doing the insurance, because I could have got another client and brought more money under management. And my response was, I have no doubt that you could effectively do what I do and maybe just as good, but you can't do what I do and what you do at the same time at a high level. So how about you hire me as a member of your team with no overhead, and let's work on 3 cases together, and you're going to know very clearly after that whether we're good fits for each other.
Very good. Very good. I, going back, I in 100% agreement. With the selection process. It's just my opinion here, but I think you should plan your life insurance needs with a financial planner, as you said, who is duly licensed both in life insurance and securities, and is knowledgeable in investments to help their clients build a living estate, and in life insurance to help them buy the time to acquire that estate. And those 2 areas of financial planning are inseparable, since you don't know how long you're going to live. That's, again, we truly, you as advisors, you help your clients plan for that certainty of uncertainty, and then how long it will take to acquire that estate. So I think those 2 go hand in hand, and I'm glad you brought that up. I would doing that financial planning and being solution based is crucial. And your compensation methods there seem very fair, and it's good information, I believe, for our audience. For those who have a lower readiness level, and in your term, haven't had recent relevant successful experience at this task, and this task is introducing risk management products. Beautiful. Look for actual ability. successful, relevant ability. So with that, Rod, great talking to you over the course of the last couple of weeks. Well done. I'm going to turn it over to Dan. I'd like to have him take us home.
Yeah, definitely want to just follow up on that. Going back to my experience and career in a similar role, but again, doing different products. I was in a dual advisor office where I was just starting out my career. So I was meeting with the newer advisor. So I'm just sitting in the waiting room waiting for the junior advisor, and a life insurance partner comes in and first thing just goes to the assistant. No hello, no nothing, just, hey, I'm going to need you to pull a client list for, advisor X, and with these criteria, and we're going to need these for the meeting that we're just about to have. And then goes over and sits down and literally was just process product. And after my meeting, I came out and I heard the junior advisor and the senior advisor talking, and the senior advisor was just, can't believe that clown did that, ordering my assistant around, and just the powwow in the background of hearing their reaction to that approach. The key is going to be, how does that partner come into your office and start that conversation? If it's all in that directly to process, directly to product, it's probably a red flag that this person is not going to be working on a consultative process, right? Whereas what you've described, Rod, is coming in and understanding the advisor's business, being that trustworthy advisor that we talk about, working on that, consultative basis. And then the second thing that I would throw in there, just from my experience, is time and territory. As you mentioned, I built my practice exactly the way that you did, which is I'd rather give up a sale today or business today or a client today to have 20 more. And so I'm going to tell you what is right and what is true in order to build that relationship and build that. And I almost would hope for it. Like the first time that an advisor would call me, I almost was like, yeah, when they call me, I'd be like, yeah, you know what? That's not really a good fit for us. You need to take a look at one of the other partners for that, because that credibility build with an advisor was huge. And so those are the things that I always pointed out to advisors is look for, is how is that partner presenting themselves, and then how long have they been in that territory? Are they a here today, gone tomorrow? And you've been doing this in your neck of the woods for how long?
Well, now 20 years. In fact, September, right. I just moved into my 20th year.
Right. So somebody that's been there doing it for 20 years, probably not going to pack up and leave tomorrow. So that takes us to the end of our conversation for this week and a wrap up of the series. And I want to echo again Philip's comments, say thank you so much for spending time with us. Again, if you have interest in reaching out to Rod, asking questions, even if you're not in the neighborhood, and Rod is a tremendously giving person, certainly have a conversation with you. Reach out to him. His cell phone, 847-305-0600. Again, 847-305-0600. And his email, rcrandall, that's CRANDALL at USAdvisorsinsurance.com. Again, rcrandall at USAdvisorsinsurance.com. Once again, thanks so much, and we look forward to talking to you again on a future episode. Rod, we'll have you back soon.
Thank you, guys. Appreciate the time.
And that will wrap up our conversation with Rod Crandall on the critical value of life insurance. I again want to thank him for taking the time out of his busy schedule to join us on the podcast. If you have topics for upcoming episodes or questions that you would like us to answer on the podcast, reach out to us via email, info@value-ability.com. Again, that's info@value-ability.com. If you have topics that you would like us to cover on an upcoming episode or questions that you would like us to answer on an upcoming podcast, reach out to us via email, info@value-ability.com. Again, that's info@value-ability.com. You can also connect with us and send us topics and questions via social media. We have Twitter, Instagram, and Facebook accounts. Go to value-ability.com and click on the Contact Us tab to get all of our social media links. Wherever you find us, please like, review, subscribe, and share, especially the last one. You can really help us out by passing on the podcast to someone that you think would enjoy listening to us. Next week, episode 30, Caring for Retired Parents. As some listeners will know, I took care of my mother during her retirement, so I will share my experiences, and we will discuss the role of the advisor in dealing with clients as they go through that process. So check back next week for that. We're 30 episodes in. We have picked all of the topics. For our consistent listeners out there, let us know what you would like us to cover coming up. Obviously, people are liking what we pick, but we also want to know what topics are our listeners interested in. So please reach out to us via email and let us know, info@value-ability.com. What are some topics that you would like us to cover in future episodes? As always, thank you for listening. Be sure to join us next week. And remember that financial success comes from building a plan on the foundation of your values, and building your ability will help you get there. This is a podcast collaboration, not a peer-reviewed journal or a sponsored publication. We make no representations as to accuracy, completeness, correctness, suitability, or validity of any information in this podcast, and will not be liable for any errors, omissions, or delays in this information, or any losses, injuries, or damages arising from its display or use. All information is provided on an as-is basis. It is the listener's responsibility to verify their own facts. You should be aware of the real risk of loss in following any strategy or investment discussed on this podcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this podcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this podcast. Before acting on information on this podcast, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor. The views and opinions expressed on this podcast are those of the authors and do not necessarily reflect the official policy or position of any other agency, organization, employer, or company. Assumptions are not reflective of the position of any entity other than the authors, and since we are critically thinking human beings, these views are always subject to change, revision, and rethinking at any time. Please do not hold us to them in perpetuity.